Hey, this is Warren Redlick. I'm here with Alexandra. Alexandra is a friend of mine from Twitter and other parts of the internet, and Alexandra has become somewhat known for analyzing certain ETFs or mutual funds, including ARK Invest in particular, that we're going to talk about today, as well as Gary Black's, I think it's called Freedom Fund, and Gerber Kawasaki's GK. What is that fund called?
Well,
Future Forward Fund?
Gary's is Future Fund, but Freedom is probably cute as well. Well, thank you for having me.
For starters, Alexandra, what got you interested in looking at these ETFs?
So all started with Tesla, and that's why we know each other, right? So in my long life, I'm 56 now, I was a fund manager and I was a senior credit officer, senior VP for Moody's, the rating agency. So I was always in this fund universe, and we can talk a little bit more about that later. But I was always diversified in our investments. And when I learned about Tesla, the car, drove one, have two now, got interested in the stock, bought stock, I realized very quickly that this is so special that any other alternative investment had no standing anymore. So I did what everybody taught me never to do, meaning I diversified only into one stock, meaning Tesla. Obviously, Tesla being such a diversified stock, in the end, I convinced myself. But then I had all my radars out there thinking, oh my God, now I've got all my money in this one stock. I have to make sure I understand what other people could do to influence it. And then so I researched who had most stock holding. So of course it was Elon, but then in the ETF sphere was ARK, who had, with the other two other ARK funds, a total of 5.5 million Tesla shares at that moment. So I thought, okay, let's watch these, what they do on a daily basis. And we can probably get into why on a daily basis and all that a little bit later. But that gave me a big insight into one of the biggest holders of the stock, what they were doing on a daily basis. And so I had my control freak moment every day, checking what they were doing, what should I do, what influence could this have on my little portfolio and all the others. And then I started publishing every day my little table of, how I looked at them. And in the summer, you're right, the summer 2021, Ross launched his GK fund. A couple of weeks later, Gary, his future fund. And so I inserted those two as well into my dailies. And then there is one of our common Twitter friends was interested in also including BCAR, which is an only EV concentrated ETF. And so those are the six I follow daily.
Just to be clear, I consider myself diversified because I own Tesla in multiple accounts. But you said, I think in a sense, and Elon says this, that in a sense, Tesla is diversified because it is not a single purpose company. Although its main source of revenue is electric vehicles, there's a lot going on in Tesla. So can you just briefly comment on to what extent Tesla itself is diversified?
Oh, and obviously already the whole supply chain, they are actually having from raw materials to the finished car, a lot of integrated sectors that usually an OEM wouldn't have. They have, for example, Volkswagen has 40,000 suppliers, right? So they are just the ones in the end building the car together and launching it and distributing. Tesla is vertically integrated with a lot of supplies, but then also we have the whole energy sectors and so many other aspects of Tesla's business, maybe soon the bots, that Tesla by itself is probably an ETF by itself, just covering all the different segments you can. There's actually a very good account. Maybe I sent you the link later. Nitzao, he's a French guy, and he does tables every couple of months showing the diversification of Tesla. That's a very good thing to follow.
You became aware, or you started following ARK Invest, and just to be clear, ARK you called it, is ARKK. The company yes. ARK Invest has multiple funds, and yeah. ARKK is the main one. There's one that focuses maybe on genomics. I think there's two or three others.
Yeah, I think there's 7 or 8 others, and they also have managed accounts. So they had at one moment much over $50 billion under management. That has obviously melted down with the market and with some investment decisions that weren't as successful as they'd hoped for. So for me, it was very interesting, just from the Tesla side. And when I look at my tables from 15 months ago, they were all Tesla oriented. I didn't look at all the rest of their portfolio. Today, I'm also looking at other things of their portfolio, notably in a smaller of their funds, which is called ARK Q. So the fourth letter is a Q, where they have a lot of other EV makers in there. So they have the three Chinese ones in there. They bought 2 days ago GM into that fund. So that was obviously the big upset in the Twitter sphere. So that's one that I look very particularly, just seeing if I can deduct the strategy from what they're doing, which is not always the case.
Okay, so my question that hits me at the beginning, and you know my view on Tesla, I consider myself a long-term investor. I actually have come to the belief that there's no such thing as a short-term investor. There are long-term investors and there are traders. If you're a short-term investor, you're just a trader. But as a long-term investor, I don't really worry about the dangers that Cathie Wood or Gary Black or Ross Gerber will manipulate the stock in the short term, or even Elon. I worry about the long-term value of the company. Since I don't plan on selling until maybe 2030, the daily ups and downs, like the stock is very much down today. I forget what the number was. Last I saw it was in the 730 range.
Yeah.
And I suppose I should panic, but I started buying when the stock was like $38 a share. So for a lot of my holdings, I'm still up like 10x. Probably on average, I'm still up like 10x. So why should I, as a long-term investor, care about short-term traders potentially manipulating the stock price in the short term?
You should not. You should not worry about it at all. You can very well live without looking at that. For me, it's interesting in two aspects. First of all, because I come from the fund industry, and I consider Cathie Wood did something very disruptive in 2014. We can get into that if you want to, because this mutual fund market was a very cozy space. Lots of people made lots of money without having to invent themselves, sort of like the OEMs and Tesla coming. She did some good. So that's interesting by itself. And then the other thing is, the market itself is only a huge risk if there's a real macro upset, right? I mean, what we're seeing now is probably a short-term one, but will smoothen out. But there could be a couple of events. I mean, sometimes just because I'm the character I am, I always like to look at the worst case scenario as well. Let's say, what would be a worst case scenario of if the whole Bitcoin bubble bursts, or if there's a real recession worldwide, or if the Chinese economy crashes, or if these actively managed ETFs have an issue, because that's maybe a bit too theoretical for here. But what Cathie Wood did is she disrupted the industry in a way that the industry had given in, okay, let's do ETFs to copy benchmarks, right? So there was the NASDAQ, or there was whatever, the Russell or whatever, copied into a passively managed ETF, passively managed meaning just replicating, right? And there she came and said, look, I'm an active manager. I do stock picking. I have my own things. I bring all my wisdom with me, but at a cheap management fee of an ETF. Right. So that was obviously very uncomfortable for the Fidelities of this world, that, you know, this woman came and she had the success she had. Now, did she have the success because she found Tesla and Tesla succeeded? Did she have it because the market was with her during COVID? Lots of people can debate that. But what is clear is she completely disrupted that industry. And so now you suddenly have a lot of money in actively managed ETFs, but it is actually a contradiction, because you would think that a very intelligent active manager who, you know, one of those star managers, should deserve much more than the little ETF management fees, right? So that's the contradiction, that's pulling. And so my interest in this all is also, will these actively managed funds survive? Will, you know, but that's an industry point that probably somebody just investing in Tesla doesn't really worry about.
Right.
And shouldn't be.
Well, and I should disclose here, I believe I own a small holding in GK, and I at least used to own a small holding in ARKK. I think I sold the ARKK because I needed to sell something, and it was like harvesting a tax loss. It was a capital loss. It actually fell from when I bought it. So
probably did, yeah.
So
given how it's,
I bought it a while ago, but you know, you know, anyway, I at least did sell, and I am somewhat of a fan of of Cathie Wood and ARK Invest and Sam Corris and Brett Winton and Tasha Keeney. So who are analysts on Cathie's fund. I just wanted to disclose that because, here I am talking to you about this, and I know you're going to be somewhat critical about ARKK, and I might defend them. We'll see what happens. So let me just tell you the reason why I bought ARKK.
Yeah.
This is before I wasn't quite as all in Tesla as I am now. And for those who are watching, in my own personal IRAs, I have 2 IRA accounts. I am 98 and 99% Tesla. Last I checked, I have a couple of small holdings. Other than that, I looked at the way Cathie Wood analyzed things and the way her fund analyzed things, and I thought, okay, I don't really want to get deep into all these other emerging technology topics. She seems like a smart person. I'll make a small bet to follow what she does. Same thing with Ross Gerber. Now, I personally, I enjoy Gary Black's analysis, but I often disagree with him. So I decided not to invest in Gary's fund, but I bought a little bit of GK and I bought a little bit of ARKK. And it was just sort of like, I like the concept that Cathie started with, which is that and I think I probably agree with you that there's some fundamental flaws with the concept, but that there are certain companies that are revolutionary, that will revolutionize industries. And Tesla being the prime example of a company revolutionizing industry. And Apple did this with phones. So it's not the first time. Amazon's done this with shopping. If you can identify a company that's going to revolutionize an industry early, then you can make outsized gains. And I figured, well, I don't want to do all the research to try to figure out which company might be revolutionary. Cathie's doing all the research. I just like her. I'm not saying I've done this, I don't actually always agree with her analysis or the ARK's analysis of Tesla. They did like a Monte Carlo model, and I was kind of like, well, I didn't really like the Monte Carlo model, but I just sort of appreciated that outlook, like maybe she's going to find one of those companies. That if you're looking for it, you might find it.
Yeah, and now let me put that a little bit into perspective. My view initially was the same positive view. I mean, I didn't want to divest from Tesla. Mine, as I explained, was more monitoring what's happening. There are lots of stock there. I can get a daily insight. It was interesting. Let's check it out. So I started mid-February 2021 and added in the summer GK and FFND. And so I followed her very closely. And as you said, they published in that time span that Monte Carlo model for Tesla evaluation, which I profoundly disagree with. I mean, like completely disagree with. I think Monte Carlo is exactly not suitable for a company like Tesla. You have to fundamentally understand this company. You have to understand what they're doing. You have to understand where Elon wants to carry it. You can then put probabilities on the bots and on the robo-taxis and on this and that. And that's how you get your pricing model. I mean, we've gone through it lots of times with you explaining your napkin math. I do mine here. And I'm probably not exactly as bullish as you, but I'm very much out there.
Not many people are as bullish as me.
So when that Monte Carlo thing came out, that was my first hit, right? And I said, why in the world make it more complicated? One thing I've learned as a mother and 5, never make it more complicated. Life's complicated enough, right? And then add to that I have a strange character between big mouth on one side and over prudent on the other, right? So I'm always navigating between those two, probably like lots of mothers or women do. And so I looked at this thing and I thought, that doesn't make any sense at all. This whole Monte Carlo thing and how it was published and the whole communication around it really gave me a bittersweet taste. Continued following them, saw stuff that I really didn't like, including that 10% limit. So let me explain that quickly. The largest holding in the fund can only exceed 10%. If she had bought it prior and the price increases, then she carries it. In reality, can be carried up to 12, 13, then she starts trimming as well. So
12,
it's not
13 what?
Percent of the fund value. Okay. So that doesn't sound like much, but when you have a market where the rest of your portfolio, so the other 90% perform badly, those 10%, even if they don't increase, if they just stay stable, they increases in proportion to the rest, right? And so she started trimming. So long story short, what we had 15 months ago being 5.5 million shares of Tesla in those 3 funds are today 1.25. Okay, so she sold 4.25 million shares, which is obviously enormous, right? So when I started understanding how this trimming constantly shaved off Tesla all the time, I got very unhappy with that, because I was thinking, well, if somebody is in ARK thinking, okay, Tesla is her strongest horse, strongest believer, that's why she has most of it in it. The whole communication is Tesla. If you ask people that are less in the market than us, what you know Cathie Wood for, everybody will go, oh, because she's such a Tesla bull, right? And in reality, the shaving off was that actually that part decreased constantly in the funds. So a couple of hiccups happened where I really put in question what to do. Now, for full disclosure, I then decided late summer that I wanted to put some of my IRA into one of those funds. Bit the same feeling than probably you had with ARK, thinking, okay, I'm 56, probably work another 10, who knows, 15 years, but I want to have one part of that IRA that's not Tesla related, or not only Tesla related, where somebody else did all the work of selecting the other 20, 30, 40 stock, is paid to, to look after them and does good adjustments and whatever. So there I really started looking, okay, will I take an ARK, will I take GK, or will I take Gary Black's? And I took Gary Black. So I did investments at 3 moments in Gary Black's fund, and for one of my children's 401k, we also went into FFND. So do I agree with everything Gary says? No. But do I trust him? Yes. Because the one thing that I agree with him more than anybody else is he does what he says. Does he always says what I like? No, by far not. But I mean, that would be too easy, right? But what he states, he applies in his fund. With GK, the only problem I had, I think we spoke about this on the earlier occasion, is they have cannabis stock in there, and the mother of 5, and while I'm in California, but that's just not my topic at all. So that was one of the reasons why I didn't take that one. But it was interesting investing in them. Small funds like GK and FFND come with other problems, like price finding. They're not as liquid as those ARK funds that are really traded every second. And size matters. While I think RK got too big to manage well, I think they are still quite small. Now let me get to that moment you said what she is doing, what Cathie Wood is doing. So you're right, she's trying to find those funds that are not yet in any benchmarks. Obviously, they're not venture capital anymore. They've come now to the market, and find them and carry them to growth, right? Carry them on that moment. But she then mixes that with daily trading. So some of that stuff is only carried 3 days, 3 months, a year. And so she gets rid of stuff. For example, she got rid of Twitter 5 months ago, nearly all of it, which obviously was not the right moment, given where Twitter is now, thanks to Elon's investment. But that happens with quite a lot of those stocks. So the investor has the feeling she has this basket of 10, 20, 30, 50 stocks that she carries really those 5 years, and that's not the case. It has become a trading portfolio. On some of the stuff, she doubles down a lot, where people are really worried now because we've come very low. She's lost a lot of money. And we're today in ARK, where the fund was more than 2 years ago. We've got a real bell curve of how it went up and how it went as quickly down again.
Right. Well, they publish something every year called like a white paper, Big Ideas.
Yeah.
And I like to read it. And
yeah,
I think what you just said to me is kind of a wake up call. My general sense of ARK-K is that they identify certain sectors where there's potential for revolutionary change and massive growth. And if you get in the right company at the right time, you can be very successful. And so they sort of identified something like 5 areas of where there's emerging technology, and like genomics is one of them. And they sort of bought into it. And again, I don't even think I read the last Big Ideas. I read the one before, and I don't necessarily find what they say persuasive. But I still had the impression, like you said, that they were picking certain stocks and holding them on the theory that this company is going to grow. I didn't have the impression they did a lot of trading. I was aware of the trading of Tesla, this 10% rule, that if Tesla goes up over 10%, at some point they sell some, so they get back down to 10%. And I was fine with that, because I was really, actually, I would probably be happier if they didn't invest in Tesla because I already have Tesla.
Yeah,
right? So
but
this
they have other funds. There's no Tesla. So if you wanted funds without Tesla,
it was just the easiest one to pick, and that's what I picked. And I didn't get into, and I didn't. And the problem is the other funds are more sector oriented rather than. I kind of wanted ARK because it was sort of all the areas of focus. Anyway, so I was not aware that they were doing a lot of trading. Does that mean that investors in ARK also experience higher costs, higher transaction costs?
Indirect costs we don't know because that's not divulged. And I mean that they do, while they do publish daily, there's still a lot of stuff that's not published, right? So it looks much more transparent than the old world. Yes, it is. Does it show everything? Of course not. So the trading cost, don't know. I don't think that's a real big factor because they have such a volatility that adding a little bit more trading cost is not the factor to make it extremely good or extremely bad. What they do have is they have now sensitively increased risk. So when other funds go down 3%, they go down 6%. They have good days, obviously, but they have also very, very bad days. So this year's performance since January is down 60%. And that was after an already very bad 2021.
Well, but isn't that part? I mean, there's this theory. I don't subscribe to this theory, but it seems like Wall Street does, that in challenging macroeconomic circumstances, and particularly inflationary circumstances, you sell high growth stocks, which makes zero sense to me, by the way. But so that would tend to, if they're invested in companies that are focusing on growth or have companies that have the prospect of having long-term success, the prices go down because of market pressures from these macro circumstances, which wouldn't really be the fault of ARK Invest. So why is that wrong?
I grant you that. And then I tell you, the same will tell you ARK Invest increased its value in 2020 so much because exactly of the contrary, negative interest rates, lots of money thrown into the market. There she throve with high growth stocks, right? So you have twice contradictory markets, macro environments, one's pushing her up, one's pushing her down. Where I have actually 3 beefs with them, and I'm unhappy that I have a beef with a woman, because when women have beefs with women, it always sounds like, chicken fights or whatever. And I wish it would be a man.
Just to be clear, we call it a cat fight.
Oh, you do? Well, we call it a chicken fight, but there you go. I'm sorry, but on the other hand, let's just keep it professional, because she's a fund manager making good money on her fund management, had glorious times. The 3 beefs I have is, I think her stock picking analysis is very, very far from their macro analysis. I think they have an extremely good academic team. She's hired lots of young, very well-educated people who know in depth a certain sector and have a very, very good grip on the sector, what is going to be disruptive, seeing very far, being able to imagine things that we probably can't even imagine yet, and finding that. Between that and finding the right stock to represent that is a very fine line. And I'm not always sure they're walking on that fine line. The second one I really have a problem with is the communication. You hear them a lot, webinars and videos and on TV and whatever, but whoever I ask, everybody only remembers Tesla, right? So it's all good that they speak so much, but if everybody only remembers Tesla, there's a mistake somewhere. But
isn't that because they're only asked about Tesla? I mean, I was on a panel at TeslaCon Texas, and I forget whether it was Brett or Sam was on the screen behind us. Yeah. And the topic was Tesla. They get invited to events where people talk about Tesla, so that's where they show up.
Sure, I'm chicken and egg. I don't know whose mistake it is, whether Tesla fans ask about Tesla and they give Tesla, or whether they just communicate more about Tesla. I mean, one example is that the only company for which they publish their 4 or 5 year price horizon is Tesla. They don't do it for any of the other companies, right? If they want to talk about other companies, publish it. But the third point is risk management. Okay, so I've been a fund manager. I've managed the biggest European investment funds. I've been a fund rating agency. For 7 years, rated billions and billions of European funds in the real estate sector and in the investment fund sector. And I can tell you one thing, risk management is the key to successful fund management. Everybody always thinks it's the fund manager, but if in the back of the fund manager is not a strong person who really can tell the fund manager, stop, you've gone too far, that was our limit, here you stop, the whole fund gets too concentrated, you get too blindsided, you run into your own ideas and you continue to double down, but it's not your money. You have a fiduciary risk to the people that have invested with you. And this seems to be, for me, the biggest problem with Cathie Wood. It's her, the young crew around her loves her, worships her, understands her, brings lots of sector knowledge to it, but there seems to be nobody saying at certain points, stop, hold it there, don't double down, don't go further. It's just running into the open knife again and again and again. And that's my biggest problem, my biggest worry. I started warning about this in November. I wrote long threads about it. Lots of people followed me, got out of the funds at that moment. Good for them.
Let me just pause you for a second. So you're on Twitter, you tweet about on Twitter, I think daily updates on what the 3 funds or maybe more than 3 funds are doing in their investments. And you're on Twitter, and I'm going to put a link in the description below to your Twitter account so people who are watching this can find you.
Thank you.
But please go ahead.
Thank you. So I warned in November, I warned in December. For the beginning of the year, I published a little PowerPoint, all the questions I would like to ask these fund managers. I mean, none of them, not Ross, not Gary, and certainly not Cathie, allowed me to ask them their questions, but at least those questions were out there. I mean, those are questions sometimes very picky-wicky risk management questions, or where's the money, where, you know, who is holding your securities, who is your money market maker. Very crucial role for these ETFs, because when they're in and outflows, the market maker, it's not Cathie Wood or the fund manager giving orders how many shares are now purchased or sold to compensate those in and outflows. That's the market maker. So this market maker has a really crucial role in the fund management. Nobody ever talks about him. So it's nitty-bitty grids that I know because I've been in that market, but that are crucial and I would like to know. I mean, do I need to know all this? Of course I don't. But what I would like to do is help other people ask questions as well, so that this beginning of a path into more transparency and more actively managed funds actually grows, because I think we need active managers. We need people, rather than just replicating benchmarks, because that's a whole other story. Who makes these benchmarks? Well, these benchmarks are made by the S&Ps and Moody's and MSCIs of this world. So we're again in the hands of these rating agencies and of these organizations that model a benchmark with other interests there. I've published a table a couple of weeks ago, which actually was my first one that Elon indirectly commented on, of how badly Tesla is treated by the rating agencies. That's a completely other topic I'm passionate about. And there's a lot of shenanigans going on with rating agencies. And the same rating agencies also have a lot of shenanigans going on with benchmarking. Remember when Tesla was supposed to enter the S&P 500 not so long ago, it took much longer than it should have, right? And then suddenly the big news came because everybody pressured S&P to make it. So coming back to my funds, passively managed ETFs is boring, is giving away a lot of knowledge. So I wish there would be more actively managed ETFs. That also would mean there would be much more buyers of Tesla. But it also means that investors have to understand what they're getting into when they trust a fund manager.
I don't know. I don't think you're persuading me.
Oh, I don't want to persuade you.
Let me be clear. So on the risk management side, I'm expecting them to take risks. I think the one thing that troubles me is the amount is if they're doing a lot of trading. Like my take on it is, and if they're doing a lot of trading because they're having a lot of fund inflows or a lot of fund outflows and they have to trade because they have to trade, although I don't know if it works that way. If they're doing a lot of trading because they're playing games with the market, then that's something that I probably wouldn't like. My sense was that they're identifying promising startups, early stage companies that have the potential to really, 10x or 20x or 50x, assuming they achieve this revolutionary change. And so they're putting 2% in this company and 5% in that company. And I was just sort of comfortable letting them, make those picks. And, it's a small chunk of my portfolio. We'll see if it works. And if it doesn't, all right, I took a flyer on it.
Well, let me explain to you. So every evening, ARK sends out an email with trades. Those are the trades that are positioning funds differently than what in or outflows would do. So in and outflows are just replicated. They have their portfolio, let's say, of 35 stock, comes in another 1 million. The market maker for them attributes that million, doesn't even go to, the analysts or Cathie Wood or whatever. The money, the market maker.
It automatically goes by the balance in the fund.
Exactly. It goes to the different funds. 2 million go out, chuck, sell for 2 million, gone they are. Okay, so that's the in and outflow stuff. But when they take a decision in committee, or when the stock has a certain limit, I imagine, I can only speculate. I wasn't sitting there. I wish I could spend the day with them. But if they're making a decision saying we're lowering Tesla, or we're buying GM, or we're doubling down on Coinbase, that's a decision they make, and then they have to sell something to have the money to buy, or they have to sell that one that they're decided to go down, and then they have to reinvest that money. So those decisions are published every evening in their email. So we know them by about 5 o'clock Pacific of what they have decided actively to change. All the rest is just adjustments for in and outflows, and those we know in the morning because I recalculate and re-engineer what the fund tells.
So let's be clear. My sense would be that you buy a bunch of stocks and you hold them, and okay, the inflows and outflows come in and the amounts get adjusted, and you make occasional changes on a weekly basis or monthly basis based on your sense of what's changing in the markets. And it sounds to me like what you're saying is they're making daily changes.
Well, there are some days they do very little, but there are days they're horrendous. Yeah.
Okay, because for me, like if you've picked some company that's in genomics, and like I actually think I have this theory about genomics that, have you ever heard this about nuclear fusion, that it's always 10 years, that it's 10 years away from success, and it has been for 30 years?
Exactly, we're still waiting.
And I feel like genomics is 10 years away from profitability, and it has been for 30 years, maybe 20 years. Maybe it's 5 years away from profitability.
Maybe it's tomorrow, but we've been waiting too long for sure.
Yeah, and I think there are other topics in their funds that, for me, what happened with Tesla was I just saw it. And actually Amazon in 2013, I just saw it as an Amazon customer. I just said, wait a minute, I'm addicted to this company. I'm going to their website every day looking for deals. Other people, I'm an early adopter. Other people are going to start doing this. And I had this moment, and I followed diversification. Unfortunately, I only bought a little bit. I bought like $5,000 or $10,000 of Amazon stock when I should have bought like $100,000 of Amazon stock. And had I bought $100,000 of Amazon stock, that would have turned out really well. When I got Tesla, I had the lesson from Amazon.
See?
And I didn't buy just $5,000 worth of stock. I bought a lot of stock. And that's turned out very well for me. Even with the latest downturn, that still turned out very well for me. So it sounds like they're not doing that. They're not.
Well, they're doing that. They're doing that for a solid part of the portfolio. When you look at their portfolio, you have the feeling they initially allocate about 5% to everything, and then it grows. Certain grow, certain go a little bit down, and then certain get to the 10% because they're more convinced about one or the other. And then they shuffle around among them, or replace one, or replace half of one, and whatever. So yes, it's much more active. It's daily. There's hardly a day without a trade. I think I've seen one day without a trade. So in 15 months, there are usually, I'd say, 8, 10 trades. Okay, there are days with 30.
Just to understand, are the trades sometimes just rebalancing the stocks within the fund, or is it like active decisions? Hey, we're buying a new stock, we're getting rid of this stock.
It's active decision. We're getting rid of half of this stock and we replace it with these 10 others in little bitsies, or I mean, what happened lately is they have a couple of really high conviction stocks, Teladoc, Coinbase certainly today, and they just feel the market doesn't get it. It's plunging. It's already a third of what they bought it last time,
right?
But now they want to rebuy. And that is that falling knife theory. And that's actually one that I think is most disturbing to me. I don't say you can't make bargain purchases today. Maybe you can, we'll see. But the thing is, when you're doing a public fund, always running into those falling knives and hoping that you're right, the last year has proven that they're not right. It's gone down and further down and further down, and they're just grabbing it and grabbing it. And so they're increasing those losers a lot.
Well, let me just, so I know Coinbase is an exchange for cryptocurrencies, and Teladoc, I think, is a virtual medical service where you see the doctor online rather than in person.
Well, it's actually much more. It's also now a data play on patients' data, but yeah, go ahead.
I mean, that's a bet, right? That these companies are going to grow a lot in the future. I personally, so I use a virtual primary care through my insurance. I mean, that's one of the things I would say is a threat to Teladoc is, well, my insurance company just provides me with virtual primary care. So why do I need Teladoc? Maybe they don't have the barriers to entry, the moat that some other startups might have. Coinbase, again, there's really no barrier to entry. There's a lot of cryptocurrency exchanges out there.
And there are a couple of names like that I can throw to you. So Teladoc, I'm not enough familiar to defend them. But the one thing I feel is there could be a second or third one easily, right? What makes us all, I think, so convinced about Tesla is that any competitor trying to compete got, exactly, let's just laugh about it, but let's just give them some hope. Okay, 10 years, 30 billion, 50 billion, and maybe, okay. Now, a Teladoc or a Roku or a Zoom, I see competition, if they do it right, to be able to grab a piece of the cake much more than for Tesla, right?
Right.
So that's my beef. They're trimming Tesla again and again and again. And I think actually, and this is me completely guessing, and I may be completely off it, like a lot of what I say today, like, I can't give you investment advice, but I try to interpret and I try to understand. I think this 10% rule is there because they must have pension fund money in there. This is not just retail investors. And that actually worries me. When you have big chunks of money that are there, they give you rules, and they can very well give you this old diversification rule, never more than 10%, right? This is like old school fund management. Don't do more than 10%. And then you also have 25% per sector. Now, what does that mean for Tesla? What sector is Tesla in? I mean, this is just, it is completely crazy.
Automotive, software.
Yeah. Exactly. You can go nowhere there.
Energy.
So at one point you have this highly disruptive idea. I mean, all these ARK funds was a highly disruptive idea. I give them that. And then you suddenly have these rules. So I can only imagine that, these big chunk investors said, look, I'm giving you 100 million or I'm giving you $1 billion, but you have to have the 10%, you have to have the sector limits that they fit into my sector analysis. You have to do this, you have to do that. And that's not in the interest of the retail investor. So one question, I mean, if I would have only one question to ask ARK, it would be, what's your percentage of retail money in there compared to institutional money? Because if the institutional is so heavy, go. Leave.
Okay. All right. Something I wanted to ask you about, when you and I first started talking about this, you were upset about another YouTuber. There's a YouTuber named Stephen Mark Ryan who has a channel called Solving the Money Problem. And I often joke that Stephen Mark Ryan is a younger, more charismatic, more handsome and funnier version of myself. Like, people said, Warren, you should interview Stephen Mark Ryan. I'm like, well, what would we argue? What would we talk about? We think the same thing about everything. And everyone watching is going to say, why are we watching Warren? We should watch the Stephen Mark Ryan guy. He's a lot more fun. Of course, he apparently smokes cannabis and blows smoke into the camera as part of his videos, and you probably don't like that. But you apparently have some disagreement with him. I think your sense is that he has elevated ARK to being sort of beyond question. So what
Yeah.
I don't remember the context. I just remember you were angry about something he said, maybe in a video. Can you relate that?
Sure, I can relate that. And let me first say, I've watched loads of Stephen's videos. They are good entertainment. I often watch them in the evening to fall asleep. I do fall asleep, so I'm not always sure I see the end of them. And I think I even bought one of his T-shirts but that's beside the fact.
That's all my fans buy Stephen Mark Ryan T-shirts. It's a rule.
Funny? He's really good in slipping that in, but never mind. Let's give him that. So what I don't like with Stephen Mark Ryan is he sort of put an analogy, oh, ARK is so smart, they saw it, I being Stephen, so we're all so smart, right? And I'm sorry, ARK is making good money. Like I said, they have in the past done a couple of really good stuff, including disrupting the fund market, but you cannot just give them a pass on everything. And there should be, I mean, while he's doing a really good analysis on Tesla and is a Super Bowl like you and goes into corners and recycles anything he can find on the internet of anybody who said it and commenting on it, don't you laugh? I do believe for ARK, he is taking it easy. Like I've analyzed them 10 years ago and it wasn't 10, but let's say 5. I've analyzed them 5 years ago. They were as smart as me, so they're good. Well, that's not good enough. And that's actually giving people who are looking for a diversification from Tesla the wrong impression that somebody who is so thorough on Tesla may have done the same thing on ARK, and he has not. And so I challenged him to discuss this. I want to hear from him how the 10% limit goes with being so smart, how the current downturn of the market with doubling down on losers goes so well with all these ideas. So he answered to me a little bit on Twitter saying, well, come back in 2031 and we'll discuss then, which I'm sorry, I'm brush it off, do it, don't take me serious, that's all good, but don't promote ARK if you haven't done the work.
Yeah, I mean, so I actually don't watch his videos hardly at all, because I feel like I'm watching stuff I would have said. And then you mentioned he like finds content and just sort of comments on it. And I don't know, I just don't, I think fundamentally he's saying he's getting the same sources of information that I am. So I'm not learning anything from his videos. His analytical style is similar to mine. So again, I'm not learning from his videos. I like to watch Rob Maurer because he sort of has a different take. I like to watch Dave Lee because he has a different take. Mm-hmm. And even Gary, even though I disagree with Gary a lot, I like seeing his perspective, even if I get annoyed sometimes, and he gets annoyed at me sometimes. But I still think, he's a valuable contribution, even if I, fundamentally disagree with some of the things that he says. So, okay, so let's talk about Tesla a bit. When you look at the future, you know my napkin math. Do you see something different in Tesla that I'm missing, or do you have a different angle on Tesla that you see where Tesla's heading over, let's say, the next 5 or 10 years?
I actually believe more in the bot than in full self-driving. Now, I'm a chicken. I think not only my chicken fight with Cathie Wood, but I'm also a chicken in being prudent. So I'm not comfortable yet with FSD. I had the monthly subscription in one of the cars, and I gave up on it because it freaked me out. It's just probably my control situation where I want to make sure I'm in charge and I can't trust the car yet. And I'm sure once the car is there, I can adapt to it, but I'm not there yet, right? So it's just personal. And it's actually funny because with lots of people I talk to, women seem to have that problem much more than men. Men seem to be able to trust the machine more than the woman can. I don't know, maybe it's psychological, I don't know. Anyway, I'm not there yet. And I also have learned in my long life that when you need authorization from administration, I mean, we're coming to your preferred subject of how well we're governed, we better... how
not well we're governed, but go ahead.
Exactly. We better don't bet on that it's coming quickly, right? So for me, full self-driving revenue and robotaxi revenue is far away. Having said that, always putting all my eggs everywhere, I have 2 Cybertruck reservations, because by the time they come, I hope live in Vegas, and I think Vegas is going to be a perfect spot if ever these robotaxis work and drive
Sure.
around. Can you imagine a Cybertruck robotaxi in Vegas? I think that could make a lot of sense.
Yeah.
So in all my models, robotaxi has, and full self-driving has no revenue for the next 5 years. Okay, so until 2027, I don't go there. I do, however, believe the bot has much more usage. I actually did and I remember you actually commented on that thread on my Twitter feed. I can see a lot of stuff a woman has to do on a daily basis where the bot can be so useful. I mean, I've always been a professional woman, and I have a very sportive husband, and had always helped when my children were small. But nevertheless, there's so much that has to be done in a household, in private life, running errands, that is just such a waste of time if you want to do something else. I mean, I'm not talking about not liking going shopping from time to time, but I could do with 4 times shopping per year if that's all it needs, and the bot would do the rest. So I see the utility in my private life and in my professional life actually much more. Talking about my professional life, if you allow, I'm an immigration consultant helping entrepreneurs get green cards. A lot of these things are actually repetitive, right? Now, do I need a physical bot doing these things, or could it be just AI? Probably AI would do it. But I think that the whole development with the bot will also help AI in many other fields. So I'm much more convinced that the bot will come quicker and find more utility than full self-driving, just because for full self-driving, we need government, and I don't trust government.
Fair enough. I'm just going to push back on you a little bit that I don't trust the federal government, and I don't trust governments in general, but there are certain states. Let me ask you, because you've probably heard me talk about this before. There are certain states like Florida, where I live, that have essentially legalized self-driving cars and robotaxi networks. And not only that, but Florida prohibits local governments from trying to regulate or tax self-driving cars or robotaxi networks. So my sense is, I think you're right that there will be places that will resist robotaxi for a while.
Yeah.
But there are also places, because we have differential government, there are places like Florida that will probably be early adopters, and California will probably be an early adopter because Californians love Tesla. California is the state that has the most Tesla penetration, also has a factory, and it's very high tech, technophile state.
Yeah.
That certain states will adopt it early. Las Vegas will probably adopt it early, Nevada. And some of the places that will adopt it early are tourist destinations. So people will travel to Miami or Orlando. They will experience robotaxi, and they'll say, why don't we have this at home? And not just voters, but government officials will travel and say, wait a minute, why don't I have this for myself? There was a critical moment during the Boring Company presentation, one of the presentations to a Clark County commissioner or something, where one of the commissioners said, I looked at this is going to reduce my commute from 35 minutes to 7. When can you, he didn't say, when can you start? But it was, all of a sudden, like the Clark County officials were like, wait, this benefits, this isn't about my voters. This is about me. And government employees often have conventions in places like Las Vegas and Orlando. Those are the 2 biggest convention sites in the United States. If Las Vegas and Orlando have robotaxis and Boring Company tunnel systems, then every city is going to adopt them quickly. And then Europe will be difficult, and Michigan will be difficult because the auto companies dominate. New York will resist because New York is stupid. Massachusetts will resist because Massachusetts is stupid. I'm sorry. I'm from New York, and I'm from New York State, and I've seen it. I worked for the New York State government. But I think, and we've seen Germany resisting Tesla's factory. We've seen a lot of that. But once a lot of people experience it in places that allow it, I think that would do. So tell me why you think I'm wrong about that path for robotaxi to become widespread.
Well, the first thing is, I'm less confident on California than you. Yes, the Californian drivers and the Californian public is there and wants to have it. Government officials, they're sitting in some key positions for this. And there are lots of people that hate Elon in particular, Tesla in particular, rich people in particular, and Tesla still has this rich people smell to it. So I'm a little bit less confident on California than you are. Nevada, Texas, Florida, I'm quite confident, but just think about it. Texas now has Austin and still doesn't allow Texas to sell Teslas because there are no dealerships as franchisees.
Right. So I have a friend who bought a Tesla Model S refresh recently, and somebody brought that up in a conversation in the Clubhouse app, and she poo-pooed it and said, look, it was no big deal. There's some technical rule that has to be complied with, but it was very easy for her to get her car. So
sure, and I'm not saying you can't get around it. And the same way I think you can get around actually sitting in a robo-taxi, even though the California may not have officially put the stamp on it. But I'm talking about, you know, real official approval. And I just think as soon as you have to do with bureaucracy, I mean, I don't know whether it's age, you know, me getting abused after too many years having to deal with the governments. I just don't see it so quickly. I'm not saying at all it won't work. I think that the technique, the whole full self-driving will work probably in a year or two. But the moment robotaxis can really pick you up at home, bring you somewhere, maybe even overnight drive you somewhere, you know, very far, and you just arrive fresh and pampered next morning somewhere, that's still way to go.
okay. So I'm just going to say, so I drive FSD beta on a daily basis. I drove it today. I drove it to the service center to get something fixed, which is covered under like a warranty. But they gave me an Uber voucher. And on the way from the gym to my home, I took an Uber to the gym, and then I took an Uber from the gym to my home. Uber's map was wrong. Like Tesla's nav actually is also wrong, but gets within like 10 feet of it. There's my neighborhood put up a chain between two sides of the parking lot, so you can't get through to my garage, but it gets you within 10 feet of my garage.
Yeah.
Maybe even 5. But Uber directed the driver to drop me off on a 45-mile-an-hour highway with no shoulder.
Ooh.
And, you know, it's not like there's, you know how AI works with Tesla FSD beta. I hit a button that tells Tesla, hey, you should look at this segment. So you look at this, the last 30 seconds of video, so you can figure out what happened wrong here, and you can try to update the software. There's no button for the driver to hit telling Uber, hey, you told me to drop the guy off in the wrong spot. They're not learning. That's one of the beauties of what Tesla's doing. So I would just say, I think it's really, really good. And what I mean by that is it's really safe, and it will, generally speaking, get you from point A to point B. It's annoying. It's annoying in the sense that it doesn't drive fast enough. It doesn't drive aggressive enough. It makes mistakes that are not dangerous, like it chooses the wrong lane and it might take you out of your way. In some cases, it might take you out of your way 5 miles out of your way. Usually it takes you out of your way, you know, a minute. And again, that doesn't happen a lot. The lane choice, if I were to pick one thing that they need to work on, it's lane choice behavior. And apparently they're very well aware of this problem and they're working on it. But but it's actually strikingly good if you set aside the desire to get there fast. Like I will, if I'm driving 20-minute, let's say 25-minute drive, I will get there I'll get there in 20 minutes, and it'll get there in 28 minutes. It's just, it's not aggressive enough, which is fine. I mean, you know, if you're not in a hurry, then it's fine. And if you don't, you know, for what I would say is the average passenger, this is the thing that I think people don't get about FSD. If you are sitting in the passenger seat with another human driver, you probably get what I would call the intervention urge on occasion, depending on the human driver. So when you're driving, when you're supervising to FSD beta, you not only have the intervention urge, you have the actual ability to intervene. I'm not going to be too specific, but I went to a city and someone picked me up and drove me around. And it was one of the most terrifying experiences of my life. This particular person was the worst driver I've seen. Like, I taught my kids to drive, and this guy was way worse than they were on day one. Well, not day one, but after the first week, they were better drivers than him. It is, if you compare FSD beta to how I drive, nobody drives the way you drive. Sure. So even your spouse or your brother or something like that, their driving is going to annoy you. And if you tried to compare your intervention urges with human drivers to your intervention urges with FSD beta, you probably have about as many with the typical human driver.
Yeah, but let me explain it differently. I think once we are at the robotaxi, you will use a robotaxi like people today use a train. When you use a train, or in Europe, one of those street cars, you never worry about whether you would do that in your car now in 20 minutes compared to 28. You are just passively in there, you know it's working, and it will take 28 minutes, it will take 28 minutes. You know, there's not even a function in your brain that will compare it to another situation.
You don't watch.
So
you don't even watch the decisions.
You're passive, you're relaxed. It's not your story. The thing takes you there. Today, we're not there yet, right? If I drive FSD, I'm just, you know, I feel like I'm better, and then I have to take over, or it stresses me out because I don't know whether it's doing it right. And I'm not at the comfort level yet, but I completely understand. And I watch, you know, Omar's videos.
Omar Kazi is a Whole Mars blogger, Whole Mars catalog. He has a channel where he does
and
FSD
I
videos.
love those. And I mean, I look, and first of all, we get the whole San Francisco landscape and nice neighborhoods and everything. But it's also just, you know, it shows where we will go. And once you're relaxed about it, which I'm not, but once you're relaxed about it, this is where it goes. So get me right. I mean, I love everything about my Tesla. I love the outside, the inside, the tech, and where it's going to bring me. I love it when I get an over-the-air update. Actually, fun story. I'm also watching, you know, what happens on Google. You know, this is my antennas out moment. I also watch what they're writing about Tesla Grünheide in the German press. So I have all my Google alerts about all that. And so this morning they were all freaking out because the Teslas in Germany got their first OTA, right, over-the-air update. And they call it in German Funkübertragung. Now, Funkübertragung, other than you can't spell it, means really a middle-aged word of, you know, how one radio and another radio communicated in the 50s, or I don't know, even one, right? So they haven't even found a German word for it yet. I was laughing. I was like, oh my God, you've got miles to go until you understand what these cars do.
Yeah. Yeah. So, all right. So I think the question, I'm actually thinking about doing a video series where I interview people. So I'm going to start with you.
Oh, there you go. Thank you for the privilege.
It's a how-to series, how to value Tesla stock. So can you in 5 minutes say how you, because we talked a little bit about robotaxi and bot, but can you just sort of give people a rough idea? How do you value Tesla stock? What analysis, you know, I'm not asking you to put, you know, figures on the screen, but what kind of analysis do you do that leads you to your sense of where you think Tesla stock is going?
Right. I mean, obviously we didn't prepare that, so I can't give you really figures, but what I'm looking at is penetration of the EV market. And I'm very privileged of living in Santa Barbara, which for me is ground zero for Tesla, right? We're in the middle of California. So we have the LA influence and we have the Silicon Valley influence. We have a small town that's rich. So you see Teslas everywhere. I would think that today, on a normal day, you have between 15 and 20% Teslas when you go out in the street, which is crazy, right? But like I said, I think we're ground zero. Obviously, you won't find the same in Chicago, or you won't find the same in Kansas yet. But I do believe we're probably 2-3 years ahead of the rest of the curves. First of all, they have to produce them. And as they explained to us yesterday, just there is only so much supply and so much they can do. So my first estimation is, you know, how much will they sell in 3 years, in 5 years, and in 10 years? I actually took him for granted when he said 20 million in 2030. Now, yesterday he told us, oh, maybe. Well, I still think they will do it, just because they have been good at sandbagging lately, right? So my linear exposure of growth in number of cars. And then the other thing is obviously how much margin do they make? Will they continue to have a 30% automobile margin? And I do believe they will. I think actually they will increase it, which is absolutely crazy, but that comes from software, right? Anything that software has a much higher margin. So you will increase the whole automotive margin by selling more of those, or by selling just them, by functioning them as robotaxis. Then I have my second model where I plug in from about 2027 onwards robotaxi revenue. And there it gets complicated for me, because if I start with the idea that in 2030, they will produce 20 million cars. How many of those are going to be not for sale anymore, meaning operated by Tesla? And that's the guess game, right? That's the guessing game, because they obviously will make so much more money if this whole robotaxi thing works on cars they keep themselves and operate themselves than by cars they will give into it. And then there's the energy, the solar, the mega packs, which are just linearly align at the moment. I don't give them a huge growth margin there. There is a huge market, but I just believe there is only so much they can do with batteries, that they are probably better deployed today in the cars than in the energy sector.
Okay. So
that's why just coming back to the earlier thing, that's why this Monte Carlo thing just drove me mad. Right?
We'll talk about the Monte Carlo thing in a second. I just wanted to mention, I think one of the other reasons that margin is increasing is because they're getting better at manufacturing more efficiently. And Sandy Monroe's video talking about what he saw at Giga Texas at the Cyber Rodeo, I think that really laid it out. I've heard that they're getting 50% margins in Shanghai.
Wow.
That their cost of manufacturing in Shanghai is lower. And I think that the cost of manufacturing at Giga Texas and Giga Berlin will be even lower because they've adopted new manufacturing techniques that lower the costs even more. You know, front and rear castings, this making the batteries on the top floor and then gradually bringing them down, and you just drop the battery pack into the car as it's being assembled, and you just end up with an incredibly efficient manufacturing process, fewer parts, fewer processes. And on the one hand, it means you're able to make the vehicle for less money, but it also means you're able to increase volume of production because you're using less floor space. So I think margin is not just software driven. Software could be a huge driver of a lot of margin, like crazy driver of a lot of, but even on just a manufacturing basis, now we're at 30%. I think Fremont is the thing that's slowing that margin down. And if you took Fremont out, I think we might, I think Shanghai alone was probably already at 50%. And when you add Texas, Berlin, and a new factory in Shanghai all together, I think margins are going to be potentially over 50%. And that's stunning.
That's not realistic. Yeah, what I would like you to include in those questionnaires, because I think it's one thing that us Tesla bulls never talk enough, is what's the biggest risk, right? And because,
well, you know my answer.
Tell me.
Government.
Well, which one?
All of them. I mean, the U.S. federal government is a big risk. The Chinese government's a big risk. European governments, all of the governments have demonstrated their potential. The Alameda County government, every single government. I mean, I would say, in my experience, that Texas governments are less likely to be a threat. That's why expanding in Texas is really important. The German government has already demonstrated it's a threat to Tesla. The Chinese government, right now with the Shanghai lockdowns, has demonstrated it's a threat to Tesla. The Alameda County government demonstrated it's a threat to Tesla. And the US federal government, there's so many, at least on the Democrat side, there are federal officials who keep talking about negatively about Tesla and Elon. So outside of those, and I guess the California state government, maybe, I don't think they've been that bad. So yeah, I think Tesla is likely to, there's rumors they're going to locate a factory in like Oklahoma or maybe the Carolinas. I think they will choose states that are less likely to be threatening. But but you know, competition is not a threat. There is no competition. I like to joke, and you've heard me say this before, the competition is comical. There's no real competition for Tesla, either in vehicle manufacturing, getting costs down to be able to produce in high volumes at low cost, or in self-driving, or in bot. AI training, and that's actually a question. Let me ask you again, before we get to the Monte Carlo model, one of the areas that Tesla may become a leader is AI training services. Taking Dojo and their other supercomputers and using what they've learned about AI training and selling that as a service to others who need AI training.
And that will happen. And I'm absolutely convinced the first two clients will be Toyota and Volkswagen.
Really? Why? What are they going to do with it?
First of all, I think Toyota is so much behind currently that there will be a really hard wake-up call, and they will understand that they have still a hardware production model that has proven to work. I mean, they have been for long years the most efficient car makers. And the only way to stay alive will be to put powered by Tesla software into them.
But you're talking about they're going to use the robot, the full self-driving in the car, or they're going to use the AI training service to train in other areas?
Well, I was talking about the software in the car, but not only full self-driving software. I think the whole infrastructure software in the car, not only the part that is full self-driving, because you obviously have Teslas today out there that are not full self-driving. I mean, they have the autopilot on the motorways, but they're not using full self-driving, and yet they're still light years ahead of anything else that's out there. So I do believe Toyota and Volkswagen will be the first ones. Why Toyota? Because it will be a hard wake-up moment, and they will say, okay, that's the only way we can do. We have too much of a delay. And the second is because Volkswagen, because Diess is already more...
CEO Herbert Diess, yes.
Herbert Diess, CEO, is already much more in the topic than most of the other OEMs, and much more, you're gonna like that, much more lucid about it.
He's more forward thinking.
Yeah, and so he will I mean, they just recruited, I don't know how many other software engineers again in Germany, but you know exactly what happens. Can you imagine having 5,000 software engineers now telling them do full self-driving or do AI for the car? I mean, come on, that's not how it works. You need an Elon that has the line, you need 2 or 3 others that know how to do it.
Well, you need, what you need millions of cars with the software and the hardware on the cars generating the data.
Impossible, just impossible, just impossible. So I do believe those are the 2 that will understand it the most. We're not talking about GM and the whole thing, because I just believe, you know, their cruise stuff that gets stuck in San Francisco and has to be carried back home. I mean, this is all, I'm not even getting there. So I wanted to get back to my question of the key risks. What
do you think the key risks are?
Well, I agree with you, government. For me, China is bigger than anything else, because just so much more difficult to manage, you know. I do believe in the United States, not everything is perfect, but there are always 2 powers to it. So if somebody's getting completely out of range, you have the feeling there's somebody else stepping in and calming it down. In China, I have no grip on it. I think the key person risk a lot. Elon, closest management, right? We had this whole discussion a couple of months ago when Cathie left for 4 months on a sabbatical. You know, how risky is it now? Apparently he's back, all good, but there are a few key players in there. And obviously Elon is a big risk. So that's something, I mean, you can't have it all ways. You can't say we need Elon and then we don't need Elon anymore, but it is obviously.
Oh, but that's one of the funny things about people who are critical of Tesla and Elon is whenever Elon does something they don't like, they say, oh, Elon's bad for Tesla. And then if Elon ever disappeared, they would say, oh my God, you know, Tesla's going to be in trouble without Elon. Like, make up your minds. Is he bad for Tesla? Is he good for Tesla? I will just push back on that. I have met multiple key players on the Tesla team. I have met lower level, like just battery engineers on the Tesla team. It's not just Elon. There is a culture. There are really, really smart, really, really talented people throughout that company. Same thing with SpaceX. I believe the same thing with Boring Company and Neuralink, although I think they still need his leadership more. Boring Company less, Neuralink more. I still think they need his leadership. And if Tesla, the way I view Elon is he's an accelerator. Tesla's already poised to dominate not just the car industry, but the transportation industry, and along with Boring Company dominating the transportation industry. SpaceX is already dominating the global launch industry. Not that they're poised to, they already are dominating the global launch industry, and they have great teams in place. And what would happen if Elon disappeared is initially the stock would fall. It would be a great buying opportunity, and the next quarterly report would come out with gangbuster numbers. And then the next quarterly, at some point, the market would catch up with, well, Steve Jobs died and Apple grew.
Yeah, sure.
And
very comparable, yeah.
And Drew Baglino is incredibly sharp. Zach Kirkhorn is incredibly sharp. The AI team people, Franz von Holzhausen, there's so many incredibly sharp people on the Tesla team, and that culture is embedded. So I think that, and then it's not like Karpathy, Elon has said this before, Karpathy, the AI team, the autopilot team, the AI team is not just one guy.
Sure.
There's a big team. There's, I think, hundreds of software engineers. And, Karpathy isn't even the leader of autopilot. Ashok is the leader of autopilot.
Yeah.
So I think key man risk is significant, but the key is you can see it with Starship. Starship was headed forward with a carbon fiber design, and Elon had the power to say, all right, we're shifting this over completely. We're going to stainless steel.
Yeah.
So there are going to be big decisions that will be made that will be big jumps.
Yeah.
But Tesla's already going to succeed without those big jumps.
Yeah.
That's my
I just
sense
don't
of it.
want, I don't want Tesla to become an Apple, right? Because I feel since Jobs is gone, Apple has changed the design of the phone a bit more like this and a bit more like that, and a more the camera like this and a more a camera like that.
It's not the same game-changing innovation.
Exactly. With the leadership of Elon, stuff happens, like really big stuff and important stuff happens. And I'm sure Elon is not spending 5 hours a day thinking of, do we change the red a little bit more orange or a little bit more bluish?
Right. No, the vision to go to bot is a decision that would not have been made without Elon.
Exactly.
Typical corporate
and you have
culture.
you have to be so crazy forward looking, right? You have to envision so much more. You have to think about things like labor market and, how will this influence the world? What's the use case? What's the bad case? What's the risk in all that? That so many people, I mean, sometimes I'm there like going, wow, where is he going? And then I can follow, or I can try to follow, but there are so few people out there that can do that.
Okay, so I'm going to ask you. Let's talk about the Monte Carlo model. Let's go back to ARK Invest for a moment. Mm-hmm. You and I think have the same reaction to the Monte Carlo model. What's your? I'll leave my reaction aside. What's your take on this Monte Carlo model? What's the problem with it?
I mean, what I don't like about it is you don't need to stress your base case Tesla model by number crunching, right? By giving all these derivatives in all these ways. It's already difficult to put a grip on where Tesla will be in 5 years or 10 years. You have a couple of fundamental decisions on which you have to think it through and say, okay, I can adhere to full self-driving or I cannot. I can adhere to robotaxis or not. I can adhere to the bot or not. If you only stay on cars, well, then think about EV expansions, adoption, where will it go? What will be the car margin? So you have to do all that. That's all basic, right? Watering this down with derivatives, with thinking it through in thousands of little scenarios and then coming up with a nice bell curve and a point spoils it.
Right.
Just takes away the whole basic concept of having done the work of thinking it through. Yeah.
Okay. I mean, my take was just, you can, it doesn't add more value than napkin math.
No.
But let me ask you about, I don't know if you follow James Stevenson, who is I Cannot Enough on Twitter.
I saw the interviews you did with him.
He has very, very complex models where he basically takes like in depth all these numbers inside Tesla's financials, and then he sort of projects where he thinks it's going. And people love it. And I think it's an interesting thing to read, and I read his models. But fundamentally, for me, it's like that level of incredible detail doesn't really get past the napkin math test. Like I'm like this big believer in napkin math, right? The napkin math works, and you can get big picture sense of, okay, if they never deliver robotaxi and they never deliver bot, and they just make a lot of products with batteries in them, this is how much revenue that generates. This is how much profit.
Exactly.
Bang. And you can dive deep into every little, and I think Gali used to do this. I don't think Gali Hyperchange. I don't think he does it as much anymore. You get this hyper level analysis of like really meticulous analysis of all the little details in every spreadsheet and every, financial number. And it's like, well, what does that really, does it really add? And I love him, but does it really add value?
Yeah. And let me add that to that. So actually Elon reaction emoji on Twitter was because James used my rating table and said, Elon, now that you're done fighting with, I think it was Bill Gates that day, how about now you take on the rating agencies and show how ridiculous they are, and then had my table below it. And then Elon reacted with a emoji laughing his head off. And so I love what they're all doing, and it's not only James. But for Tesla, I don't think there is a need in constructing financial balance sheets and profit and loss accounts for the next 10 or 15 years. I mean, it may reassure you, and don't get me wrong, when I was a financial analyst, I love it. I had thousands of pages to walk through and analyze and find the thing that reassured my thesis. But the basics in Tesla are so much more important. You know, understanding this car, understanding how you can multiply this car, understanding battery capacity, understanding raw materials needed, where do they come from? Do they find alternatives? Are they able to source them better than any of the competitors? How convincing is the car? Will people give up ICE cars to those are the car questions, and then you can put them on the robotaxi, and then you can put them on the bot, and you can put them on so many other things that you don't need to get into the nitty-gritties of financials to be convinced where it is. So when people ask me, okay, so what's your price target in 4 years? And I say 5,500. Well, it could be 4,000 or it could be 8,000, but I'm still comfortable with it, right? The thing is, this company is so gigantic in potential, and I'm so sure this is the winner of them all. You know, I'm so sure there's just nothing out there. Like I said, I put a little bit, 10% of my IRA, of the IRA, not of everything, into the future fund, just so that I let Gary do my diversification, and I have this little sleeping pillow if everything else goes wrong, right? But other than that, I'm all in. And I am a person who was taught, I mean, I am the poor breed of, Alexandra, this is how you diversify. Alexandra, okay, we give you all this money to manage, but check, all these little rules, and I threw them out of the window once I saw this.
I was trained in the mean variance efficient portfolio theory from Stanford Business School. So, all right, I think you have a window. You have about a 10-minute window. You have to be out. So I want to ask you an odd question.
Go ahead.
And we're both the same age. So we're both.
Oh, are we?
We're both
1966?
Yes.
It's the best year, right? Can we agree that that's the best year?
It's been good for me.
There you go.
So I look at everything I've seen in life, and I can go back before I was born to someone like Thomas Edison or Leonardo da Vinci or whatever, and Nikola Tesla, whatever. And I find it hard to believe that Elon Musk is real.
Oh, me too. And I'm like, what a privilege to be alive and watch this happen. But I mean, so many times. And I can tell you, just for a personal story. So I found this, right? We came to the United States in 2014. My husband said, first thing we do is buy an electric car. I had no idea what an electric car was. So we bought a BMW i3, this little square thing, which was cute car. Then that one, the lease was over. We always leased electric cars because we thought, you know, the progress was there, so we wanted to be able to switch. By the time that one was over, the Model 3 wasn't available yet, so we got a Bolt, which was a nice upgrade from the BMW. I know everybody hates Bolts here, but I mean, it was a nice electric car. And then obviously since then, the Teslas. Once you understand this, right? And once you understand what these cars mean and how they operate and how much better they are than the two cars you had before, and then you understand the stock, and then you listen to the guy, to Elon, not the guy. I mean, he's much more than the guy. And then you understand where he wants to bring us and where he wants to bring humanity and how much he's taking on personally. I mean, this is a father of 7 kids. This is the richest man on earth. He could just be there, go to the beach, be on his yacht and do nothing. And instead of that, every day he mules it over and does it again and again and again to bring us somewhere. Wow. And fight all the naysayers of this world. And what a privilege to be alive and be part of it.
All right. So you're familiar with the simulation hypothesis. My theory about the simulation hypothesis is that Elon is actually a player character in the simulation. The rest of us are probably non-player characters, and he was doing too well. So the people who run the simulation increase the degree of debt. I mean, if you think about all the things that have happened in the last 3 years or so, it's like the people who running the simulation said, Elon's doing too well. We've got to make it harder for him. So let's create a pandemic and let's decide, you know, there's so many different things that have happened that, like, I mean, maybe it even goes back to 2015, 2016 with a certain orange-haired individual. Like, all of it coming together, it's just like everything's been so crazy. I mean, just the whole change in public health policy is just so radically different from anything we've seen before. The massive increase in money printing and what the inflation that we're seeing, the supply chain shortages. You know, it's probably crazy, but is it crazy to think that maybe that's like it seems like a more plausible explanation to me than all this random stuff just happened?
Well, I don't know what you smoked, but stop it. Okay. There is no simulation. This guy is real. He is a real mother. He is a real brother. He is a real sister. They all had their hardship, right?
Yes.
I mean, you know Elon's story, his childhood stories and all that.
Oh,
if this would all be...
But the answer to your question, why he doesn't just sit on a yacht and with hookers and blow, the reason is because he can't. He needs to work. Yeah. He is driven. It's not like a conscious choice. I could be doing all this fun stuff, but instead I'm going to work. He is driven. Like, it's kind of like a novelist has to write novels.
Yeah. But that doesn't put him in the simulation. I think there are lots of people that are driven.
Well, I'm going the non-simulation theory. The non-simulation theory is just, he's just wired that way. Yeah. He doesn't know how to stop. That way.
And he also sees much more than anybody else here what needs to be done. You know, he sees it clearly while we see it at our little level. And sorry to bring it back to me, but, you know, I'm a mother of 5. I've always worked. People go, why in the world would you work, right? You have the finances you need, you have 5 kids to look after, whatever. There are people who need to do a little bit more. I mean, my level is small compared to his, but this guy sees it and does it. And I mean, he has all my admiration. I will defend him, and I'm on Twitter defending him. I'm actually friends with some Tesla Q just to be able to defend him, right? Just to be able to tell them over and over again, look now, what you say now, just and going there again. Not that I like the conflict. And that's what also brought me, just bring back to the initial subject, but brought me so much up against ARK, because I think they harmed it. I think they did it wrong. So that got me motivated of digging into it even more.
Okay. So I think you're out of time.
Thank you for having me.
I'm going to let you go. This was a wonderful conversation.
Thank you, Warren.
And just really quick for everybody watching, first of all, check out Alexandra's Twitter account. It's linked in the description below. If you like this video, check out my other videos, support the channel on Patreon. I'm not actually wearing one of my t-shirts today. I'm wearing TeslaCon Texas t-shirt, but please check out the t-shirts at elonbits.com. And thank you so much for watching.